Have you ever felt the sting of losing something more intensely than the joy of gaining something of equal value? This common human experience is known as loss aversion, a powerful psychological phenomenon that significantly influences our decisions. Loss aversion is a core concept in behavioral economics, first identified by psychologists Daniel Kahneman and Amos Tversky. It describes our tendency to prefer avoiding losses over acquiring equivalent gains. Losing $100 feels worse than gaining $100 feels good. This asymmetry in our emotional response to gains and losses has profound implications across various aspects of life. For instance, in finance, investors often hold on to losing stocks longer than they should, hoping to avoid realizing a loss, even when it's financially irrational. They might also be less willing to take risks that could lead to substantial gains if those risks also carry the potential for even small losses. In marketing, companies frequently leverage loss aversion. Think about limited time offers or don't miss out campaigns. These phrases are designed to trigger the fear of missing a potential gain, which our brains perceive as a loss. Free trials that automatically convert to paid subscriptions also tap into this. Once you've experienced the benefits, losing access feels like a loss, making you more likely to subscribe. Even in our daily lives, loss aversion plays a role. We might stick with a mediocre service provider because the effort and potential hassle of switching, a perceived loss of time or convenience, outweigh the potential benefits of a better alternative. Or consider a homeowner who overvalues their property when selling, unwilling to accept an offer below their perceived worth, even if it's a fair market price. The evolutionary roots of loss aversion are thought to be tied to survival. In ancient times, losing resources like food or shelter could have immediate and severe consequences, making a strong aversion to loss a beneficial trait. While this instinct served us well historically, in modern contexts, it can sometimes lead to suboptimal decisions. Understanding loss aversion is the first step towards mitigating its negative effects. By recognizing when this bias is influencing our choices, we can consciously try to frame decisions in terms of gains rather than losses. For example, instead of thinking about the loss of money if an investment goes wrong, consider the opportunity cost of not investing and missing out on potential growth. Another strategy is to set clear, objective criteria for decisions beforehand. This can help us avoid emotional traps when faced with potential losses. For instance, an investor might decide to sell a stock if it drops by a certain percentage, regardless of their emotional attachment to it. In conclusion, loss aversion is a fundamental aspect of human psychology that shapes our perceptions and choices. While it's a natural inclination, being aware of its influence allows us to make more rational and beneficial decisions in our financial, professional, and personal lives. By understanding this powerful bias, we can better navigate the complexities of decision-making and strive for more optimal outcomes.